Welcome back. We have new inflation numbers from Statistics Canada. They are higher than expected. Here they are. The headline inflation number comes in at an annualized pace of 4.0%. What was expected, as we told you, was 3.8%, and the July number was 3.3%. So headline inflation comes in 70 basis points higher than the July number and 20 basis points higher than the consensus as derived from a survey of economists by Bloomberg News. The core number comes in at 4.1%. This is a CPI core median in the phrasing of Statistics Canada. 4.1%. That's meaningfully higher than the 3.7% estimate, meaningfully higher than the 3.7% July number. And the July number has now been revised higher to 3.9% as the core median inflation number. So you get the picture. The August inflation numbers are significantly higher than expected and significantly higher than the numbers for July. Let's digest these numbers now with Sal Guatieri. He's director and senior economist at BMO Capital Markets. Sal, you have heard the numbers. They are meaningfully higher than expected. What's your takeaway?
Well, that's the second straight month now of disappointing CPI numbers for Canada, where we're definitely seeing a reacceleration of consumer prices now, largely on the back of the rebounding oil prices and gasoline prices. But it is worrisome that at least that one core measure, the median, has now moved up above or back above 4%. Remember, the Bank of Canada has been very concerned about the, I guess, the sluggishness in the pace of decline in some of these underlying or core measures of inflation, and that number will only aggravate its concerns.
On a monthly basis, the core number rose by 0.4%. Excluding food and energy, it rose by 0.2%. So food and energy were factors. Excluding energy, it rose by 0.1%. Excluding gasoline, it rose by 0.1% as well. So on the basis of what you heard so far, how much of this is due to the volatile impacts of food and energy?
Well, quite a bit of the inflation story is still a food and energy story. I mean, it's gasoline prices that now have rebounded in the past 2 or 3 months now that are pushing up the inflation rate for the past 2 months. And food costs, they seem to be moderating, but they're still quite elevated. So that, those are the two, I guess, main sources of inflation pressure. But, underneath the surface, when you look across the services sector, there's still this underlying thread of inflation pressures. In rents, for example, and many other services. So that is a concern because it's a reflection of the ongoing tightness in labor markets, even though the labor market has loosened considerably so far this year. But with the unemployment rate still well below normal, we're still seeing wage pressures in Canada, many wage measures running in that 4 to 5% range. And it does seem to be putting some stickiness to overall inflation. Now, I think overall, trends are going to move again in the right direction. We do expect inflation to continue to moderate going forward. The economy has weakened quite abruptly. It did contract very slightly in the second quarter, appears to have stalled further in the current period, and we basically see the economy flat on its back for until early next year in response to, or lagged response to, previous increases in interest rates for the most part. And the unemployment rate has gone up, more than half a percentage point. We've created a lot of jobs in the past year, 500,000 in the past year, but that's just not enough to keep up with growth in the labor force, which is being driven by the fastest population growth in 7 decades. So, we do expect the unemployment rate ultimately to get up to 6%. That will probably put more downward pressure on inflation in Canada, and eventually will ease the Bank of Canada's concerns about inflation. But near term, it's still touch or go whether the bank will need to raise interest rates further.
And as you were speaking, we are looking at the Canadian dollar. It is edging higher. It's not exploding higher, but it's now trading at about 74.6 cents US. Earlier in the morning, it was trading at 74.4 cents before we went to air. There it is again, 74.64 cents. Up about half a US cent at this moment from yesterday. Gasoline is clearly part of the story here. The monthly increase in gasoline prices, according to Statistics Canada, 4.6%, by far the largest increase in terms of the categories of increases. On a monthly basis, food prices actually declined by 0.1%. Now, my understanding of that category is that it includes both restaurant and grocery food prices. That number came down by 0.1%, the first monthly decline in at least 5 months. Talk to us more about the Bank of Canada. You said that you don't think there's anything in these numbers particularly that will nudge the bank into an increase to the benchmark interest rate in October, correct?
That's right. Yeah. I mean, if the Bank of Canada was to base its next policy decision in October solely on the inflation numbers, probably would be raising interest rates at least one more time. But it really does have to stand back and look at an economy that, again, is basically flat on its back right now, could weaken even further because of the lagged effects of past policy tightening. So I don't think the Bank of Canada wants to push its luck too much and raise rates further. I think that the main story for the Bank of Canada is, even though rates may not need to go higher, they probably will stay high at high levels for a longer period of time. So we clearly don't expect the Bank of Canada to cut interest rates, at least until next spring or so, simply because we're seeing some stickiness in inflation.
We often hear that interest rates take time to exert some downward force. You're an expert. Tell us about the lagged effects of interest rates. How many hikes in the past have yet to bite on the Canadian economy?
Well, there's probably quite a bit more tightening to filter through the economy. Historically, the lagged effects of rate increases on the economy tend to be 4 to 6 quarters, and then for inflation, 6 to 8 quarters or so. We could see the impacts a little quicker this time. We know Canadian households have taken on a lot of debt in the past decade or so. They're very sensitive to these higher interest rates, and we do have interest rates at the highest levels in more than 2 decades now, and they've gone up so fast in the past 18 months or so. That they're bound to have a further negative impact on consumer spending power, especially for discretionary spending, as more and more households renew their mortgages, in particular at higher interest rates. They will need to cut back on discretionary spending. So that kind of underlies our overall view that the Canada's economy will basically stall for the next several quarters, probably won't resume meaningful growth until the second half of next year. And again, if the Bank of Canada sees that very weak economic performance and a rising unemployment rate, I think it probably will just stand back and just keep interest rates at these higher levels, but refrain from raising rates further.
Sal